Hi, everyone, and thanks for joining us. I'm Rafia Hasan, and I'm Chief Investment Officer for Wipfli Financial. Before we get started, I wanted to cover a few quick housekeeping items for today's program. All participants will be muted, but will still have access to the chat box, which can be found in the menu bar of your Zoom window. If you can't see it, you should press more in Zoom to access the chat window. In addition to that, we welcome you to submit any questions through the chat box. We do have several questions that were submitted in advance that we'll start out with. Any questions that we can't get to will be addressed directly by an advisor after today's webinar. So our guest speaker for today is Michael Lane, who is the head of iShares US Wealth Advisory at BlackRock. Michael has published 3 books, including Secrets of Wealth Makers, as well as a range of articles on topics ranging in financial planning and advisory practices. So thanks for joining us today, Michael.
Thank you for having me, Rafia.
The topic for our webinar today is demystifying sustainable investing. And even though we're going to spend the bulk of our time discussing that, I did want to acknowledge what has been happening in the market today with Russia and Ukraine. Global stocks have reacted negatively to the news. And as a reminder for our clients, we take a long-term view when it comes to investing. And so while the current geopolitical events are concerning, when we look at how markets have behaved during past such crises, we see that markets have had the resiliency to weather such storms. And we are advising our clients to stay disciplined and not make any changes to their portfolios in response to the events of today. Michael, do you have any additional thoughts that you wanted to share on this from BlackRock's perspective?
Sure. First of all, I think we would all agree our thoughts go out to the people in the Ukraine, and it is a difficult day for the people there and for family members who may also be all over the world, including the United States. So first of all, we are very sorry to see the conflict taking place. From an investment perspective and from a discipline perspective, those are things that we are focusing on, and we're going to be hosting different events later in the day just to make sure that people understand what are the implications of a conflict like this. And I know we're here to talk about ESG today, but it is important to note that markets tend to have quick reactions to any type of disruption. And what happened today in the Ukraine is a disruption. It's something that has been pricing into the market over time as people were growing more and more aware that this was something that could inevitably happen. And so it's not as big of maybe a shock as you might think during a day of a crisis like this, but that gets priced in over time as troops move closer to borders, things like that. We looked at the last 30 years of conflicts, things like when Russia invaded Crimea, when the US North Korean tensions, events like the Gulf War. And when you look at the last 30 years, there have been several. I'm looking at a chart right now to my left of 8 different events that have happened in the last 30 years that are geopolitical events. The markets tend to respond quickly, but then they tend to shift back to looking more at fundamentals and growth objectives, earnings as they come out. And all but one really has done fine. The markets have done well, actually, 12 months after those conflicts have started. And that's largely the one that didn't is hard to conflate because it was in 2008, and that was when Russia invaded Georgia. But obviously there were other things going on besides that, like the global financial crisis. And so our stand is people should stay disciplined. They should stay focused on the long term. I know it seems like we probably say that no matter what happens in the world, but that is what investing is about. It's about the long term. And we would suggest that in the past, markets have responded as you would hope, which is a quick reaction, and then they have tended to decline. So discipline is our focus today.
Absolutely. I couldn't agree with those words more. So now coming back to the topic at hand for our regularly scheduled program, sustainable investing has gotten a lot of media attention, and we saw record inflows into this space in 2021. I'd like to start with the basics of what is sustainable investing?
It's a great question, Rafia, and it's one that people don't always fully understand because it seems like it's something very different. When you think about investing in general, if you look at the type of portfolio you might have that has no sustainable investing sort of titles involved in any of the holdings. You're buying securities, and you're typically buying securities that are weighted differently based on whether you want exposures to things like small companies or maybe companies that are considered value companies. And so you weight them differently than just the market. And in some respects, sustainable investing is no different than that, except you're weighting the securities differently based on different factors. Instead of it being the size of the company or the value or growth nature of the company, instead it might be how do they score in terms of things like environmental issues? How do they score in terms of sustainability and social good and governance of the company? And so typically sustainable it's defined as combining traditional investment approaches with those environmental, social, and governance insights and scores.
Got it. And how can investors incorporate sustainability into their portfolios? What are the tools that they have in order to be able to do that?
I think the first thing that people have to do is they have to really take a good look at what are they trying to accomplish with their investments. So first, there's the normal goal setting that people have to go through. There's also, some people that will have different values. There may be social values that are really important to them. There are some that may have environmental values that are very important to them. Those tend to be more values-driven approaches that might influence how you incorporate a sustainable or an ESG fund into your portfolio. So values come into play. And if you're somebody that wants to invest your portfolio in line with what your values are, that's what ESG funds will enable you to do. Now, whether you buy them individually or whether you buy them in a model portfolio, that would be something to work out with a financial advisor. But the key is it isn't as easy as it used to be. I mean, back in the day, I started working in the SRI world, in fact, 25 years ago. And SRI screens were pretty simple. You would just typically divest from entire segments that maybe didn't pass a screen of usually either a religious or social type of screen. Today, it's a little more difficult, and why it does require, I think, help and working with a financial advisor, because sustainable can cover so many different areas. We talk a lot about sustainable and ESG, and we sort of intermix those two terms, but there's also climate-focused solutions, climate-aware solutions, there's low-carbon solutions, there's impact funds, there's all sorts of different things that mean different things. And so it is important to think first about when you're thinking about how to incorporate it into a portfolio. Are you going to replace an existing holding with something that is more values aligned to you? Are you going to replace the entire portfolio with an entire portfolio of values aligned strategies? So that's one way to thinking about it. The other, I typically see two reasons people use sustainable solutions these days. One is the values. The other is because there's so much moving. You said it early. In your comments. There's so much money moving into these solutions, where every company gets scored based on their E, their S, and their G contributions, and so those scores are very important to companies these days because there is so much money flowing this direction that people want to improve those. Well, with so much money moving this direction, there are lots of investors in sustainable products that actually aren't values aligned. They aren't buying them for value purposes, or values purposes. They're buying them because there's so much money moving this direction that they want to be in that fast moving river. They want to make sure that they're participating in the growth that is going to come in terms of prices and returns of those companies that have the highest scores and tend to get the most flow, the most buying of their securities in these funds because of their high scores. So there's values, and then there's just what I hesitate to say it, but I hear it a lot, the potential alpha that might be generated, or maybe a lower risk of buying these portfolios because of the governance scoring of those securities. That's another reason people tend to buy them and how they incorporate them into their portfolios.
Right, Michael, and I think it might be helpful for me to comment just in terms of how Wipfli Financial is approaching it for our clients that are interested in this space. We have some funds that we're using that are much more sustainability focused, and it is more related to reducing carbon emissions and more in an environmentally focused strategy, but that is a commingled fund strategy. So the values that are laid out are the same across the board for all investors that are in that strategy. But then we also have the opportunity to do separately managed accounts for clients where they can get much more customized in terms of what values they want reflected within the portfolio. And that enables them to have a more customized approach where that's more tailored to their specific preferences within this space. And so those are two different ways that we can approach it for our clients who are on this on the call today. So one of the other things that I wanted to ask you about was COP26. That conference was held in November of 2021. What were the key outcomes of that conference?
You know, one of the challenges of all of these conferences, I'd say right now, that everybody is struggling with, whether it be COP26 or any of the other conferences that are dealing with how to handle what is considered, you know, I hear the word a lot, a transition. How do we handle the transition to a greener economy? What is the path forward for that? How do we balance we all kind of want to leave the world a better place than where we found it? That should be all of our objectives. And one of the biggest things that I think everybody is struggling with that comes out of COP26 and a lot of other meetings that have to do with this greening of the economy desire is what does that transition look like? How long will that transition take? And what's the process to actually accomplish a greener world? And carbon emissions are one of those issues. Obviously, there's other parts of these like ESG funds than just carbon and fossil fuels and things like that. But it is one of the biggest challenges. We're even seeing what happens today with with the impact of energy in conflict. And so I'd say out of COP26, one of the things that is important for us all to realize is it's not going to be an overnight kind of change that's going to take place. It's going to take a long time, and it's going to mean that we have to be aware that there's going to be a pace of change. It's not going to be an immediate change. And I'd say those are the things that everybody is struggling with: is what is that pace, and how do we participate in that pace of change?
Got it. So switching gears a little bit, we hear the term greenwashing a lot in the media these days. What does greenwashing mean, and how is it relevant for investors?
Yeah, it's a bit of a squishy term. That's my technical way of saying it. Greenwashing, so when I first really understood how markets work and understood the world of investing, and I'll use small cap versus large cap stocks to define it, there was a very easy to understand term. Risk and return are related. And so if you want to take more risk, you would buy smaller companies than bigger companies, because those smaller companies are riskier than the bigger companies, and therefore you should assume more volatility and more risk, but you have greater expectation of return. And how much you want to expose yourself to those small companies versus large companies is basically how different than the market do you want to look. So there's the market, and then the smaller you are than the market, the more different you're going to look, and the different experience you're going to have from an investment perspective. You may achieve greater returns, but you're definitely going to have a different experience. Your portfolio is not going to move quite the same as just the general market. So that was sort of an experience with small companies versus large companies that made perfect sense to me. It was easy to understand. And for some, exposing themselves to just a little bit of that small company, index may be something that's important to them because they get a small expected return benefit, but they don't look that much different than the market. So how does that apply to greenwashing? Well, when I think about greenwashing in its truest sense is when you're basically buying the market, there's no difference of the portfolio, but they put an ESG label on it. That would be greenwashing. And why would somebody do that? The reason you might do that is because we were talking earlier about all this flow of money going into this area of ESG and sustainability. And so, there are some that want to capture a piece of that, but what they're putting it in actually doesn't weight very heavily or at all to anything related to sustainability. So that's what's considered greenwashing. The challenge with greenwashing is some people actually don't want to be all in. They don't want to eliminate complete sectors. They don't want to eliminate complete industries. And so in the ESG world, particularly in that sustainability world, there are many different exposures that you could take. There's different depths of the amount of ESG that you want to buy in your portfolio in terms of scores and impacts. And so greenwashing can be a little bit of a gray area, because just because somebody doesn't go all in, it doesn't mean that they're greenwashing. It just means that they don't have necessarily a full exposure. And I think we need, as companies, as companies like BlackRock and iShares, we need to provide choice of the depth that you want to take when you're actually making these types of investments, whether you want to go all in and look very different than the market, or maybe you want some exposure and you want to be aware of ESG scoring, but you don't want to look that different than the market. Some would say that's greenwashing. I would suggest it's not greenwashing. It's actually aligning values, or aligning somebody seeking potential better risk-adjusted returns with the amount of risk somebody takes, and risk being defined how different you look than the market. So greenwashing says that you put an ESG label on something that doesn't have really deep ESG scores, but I think that we have to be careful how we use that word.
Yeah, Michael, you've talked a little bit about kind of ESG scores. I guess one of the questions that we did get was around evaluating the strength of ESG criteria. How do you evaluate the strength of ESG criteria that a fund is applying, or a manager for that matter?
Yeah, it's one of the best resources of ESG information today is through MSCI and quite frankly through BlackRock. We've acquired quite a bit of data on ESG scoring, and MSCI is a leader in that. And so first, I'd sort of start there, because if you're using something that is based on an index that is widely accepted and well known, it gives you a little bit more comfort. So that's the first place I'd start. But there are different levels and different layers of ESG investing and sustainable investing. I'm going to use those two interchangeably. And some will want complete divestment from sectors. We'll use fossil fuels as an example. And some will understand and appreciate the fact that maybe those same industries and those companies are the ones that are going to create and implement the future fuels, the future energy sources. They're the ones that also desire to be diverse in that way, and make sure that they're capturing what the future energy sources might look like. So you can have different levels and different layers. One does not mean it's better than the other. They're just different. And it depends on your degree of desire to eliminate certain industries or sectors from your portfolio, or you want to contribute to maybe those companies that are trying to find solutions for high carbon emission fuels that we currently have.
Yeah. So another kind of related question, fossil fuels and carbon emissions are a big focus for those concerned about climate change. And there are nuances to how this is approached within the context of investment portfolios. Can you talk about divestment versus engagement in the context of traditional energy companies?
Yeah, this is probably the most charged question that gets discussed right now. And there's big movements trying to protect industries by states that are heavy producers of fossil fuel energy. And so the question comes up quite frequently: should we divest or should we engage? And so your question is really the heart of what a lot of debate centers around. And what you read in Larry Fink's letter recently was we don't believe in divestment. And we don't believe in divestment because there's no readily available, reliable replacement at this point for oil and gas. And so one of our challenges is, as we want to continue to improve the environment and continue to reduce carbon emissions over time, is you can't flick the switch today and turn off fossil fuels. And so when you divest from fossil fuels and you withdraw capital from those, what you end up doing is two things. One, you potentially decrease supply, and definitely you decrease the amount of investment so that there's less money to do research and other types of growth. And you look at some of the biggest research areas in this space that's within those fossil fuel companies. It becomes a very difficult debate because divesting actually will increase prices. The people that are most hurt by increased energy prices are the people that can least afford it. And so there's a hotly contested debate around what we call energy poverty, and divestment will likely lead to more energy poverty. And so there's this very delicate balance of making sure that we are being cognizant of the fact that what fuels growth, what fuels development, what fuels pulling people out of poverty is low cost energy. And what we need to do is have many would say is a just transition from reliable existing sources and new forms of energy that we need to invest in, and we need to continue to explore how to develop and make more efficient new forms of energy. So rather than divesting where you lose your vote, where you lose your right to engage, BlackRock has taken the response to that of being less divestment, more engagement, and working with the energy companies. It was just written about in a recent article that Larry got together with the CEOs of the largest energy companies to discuss how do we work together for a better transition, a better complement of new sources of energy with existing forms of energy that right now account for 80%, of the way that we power the world. So it's difficult to move away from that unless you have a reliable replacement, and we don't have it yet. So that's where engagement, I think, is a better outcome than divestment.
Right. And certainly, the strategies that we're looking at for our clients who are interested in sustainability and, reducing carbon emissions don't completely divest of traditional energy companies. They still have exposure within the energy space, because I think you brought up a great point, Michael, around, some of those traditional companies are the ones that do have the resources needed to reinvest and to come up with newer technologies that are going to be more sustainable going forward. So as much as we'd like to see, some of those more disruptive new companies be the ones that are introducing those new technologies, we still have to recognize that the incumbent players are going to have a role to play with that transition. And just as you said, we're not at a point today where we can just flip off the switch and turn ourselves off from traditional energy sources, right? So it is a nuanced debate that requires a thoughtful approach, I would say, to be able to navigate the environment.
Yep, it is. It's a very difficult debate, very nuanced, unfortunately becomes very political at times. And as an asset manager, I think it's very important for people to understand, as an asset manager, we have no desire to get into the political debate over these things. We really are not in a position to get into really the scientific debate over these things as a financial. Right. Our goal is to make sure that we position and we work with companies to be positioned to provide the maximum highest value rate of return possible. That's our fiduciary responsibility as an investment manager, is to not take a stand one way or the other on politics and things like that, but it is to be very clear that our job is to work with companies to provide better returns and a better investment experience for our clients.
Well, that leads me to kind of our last question for today, which we received from a couple of folks, is around Wipfli, and are we moving in the direction of ESG only fund options? And, what are the options for investors who do not want ESG? So I'll answer it from the Wipfli perspective, but we'll also give you, Michael, an opportunity to answer it from BlackRock's perspective. So the short answer for me on that question is no, Wipfli Financial is not moving towards ESG only fund options. We're here to serve our clients, and it's really a matter of what a client's preferences are. So for clients that express an interest in ESG and sustainable investing, we want to be able to ensure that we have options available for them. And so that's how we're approaching it. Michael, any thoughts from BlackRock's perspective around this?
No, same thing on our side. It goes back to like our job is to maximize returns for investors. We manage nearly $10 trillion, and that is, at the end of the day, that is the job of BlackRock. So we are a provider of choice. We believe that people should align their portfolios with their individual values, with their desire for increasing the probability of achieving goals, whether that's buying a house, funding retirement, leaving a legacy behind. Those are the things that are really, really important, I would say, to BlackRock, is for people to understand we are here to provide choice and to try to deliver maximum value for the lowest price for those different ways of investing, whether that's ESG, non-ESG, active, passive. We do make everything basically available, and our goal is to deliver the scale that we bring to help and aid in being lower priced to people.
Great. Well, thanks everyone who's joined us today, and a special thank you to our guest speaker today, Michael Lane. As a reminder, if we didn't get to your question today, we will be following up after the webinar. We hope our conversation was helpful and encourage you to reach out to your local advisors with any additional questions or assistance to navigate through your financial journey. Thank you.